Hey guys, welcome back to the video. I'm Luke, a CFA Charterholder, and today we're going to be discussing a topic from the corporate issuers section of the material. We're going to be defining and illustrating what a stock exchange is. So yeah, let's get into it. Okay, so a stock exchange. I'm sure you've come across listed stock exchanges before, so I'll quickly define it. A stock exchange is a rules-based open market venue where company shares can be freely traded between willing buyers and willing sellers with little friction. So they're venues which basically facilitate transactions of listed equity. So buyers and sellers are brought together and are able to exchange shares in listed companies. So they're organized, regulated marketplaces where connections are made between willing buyers and willing sellers, so buyers and sellers are brought together, allowing for transfers and share ownership. It's a venue where companies are able to raise capital as well. So companies who are looking to raise additional equity can go to their local stock exchange and raise new capital there. An exchange provides full price and volume transparency. So one good thing about an exchange is it provides data points. It provides a share price, it provides a volume weighted average price, trading volumes. So there's a lot of information that analysts and investors can use to make informed buying or selling decisions. It provides current and historic share prices, as well as volume data, so how many or how little trades are taking place. So it informs market participants as to how liquid a company's stock is. Is it highly liquid? Is it illiquid? Why? So yeah, an exchange is great because it provides a lot of data to investors. And yeah, as I was saying, prices on a stock exchange are driven by supply and demand dynamics. So if demand is outstripping supply, you'll find that the listed share price will gradually increase over time, whereas if supply is outstripping demand, the price will fall as there's more sellers than buyers. So a few other points here. So if a company is private and then transitions to being public by going through an IPO or an exchange listing, that allows ownership of its shares to be easily transferred between investors, as shareholders can transact directly with other market participants on the exchange on the liquid secondary market created by the venue. So yeah, a company goes public through a primary issuance, it issues new equity, and then that equity just becomes traded actively amongst investors who hold the free float in the firm. So once a company's listed, its shares are just freely traded amongst buyers and sellers who may be shorter term, maybe longer term. And an exchange listing means that buyers do not need to transact with the company directly to obtain an ownership stake in the firm. So if you think when you're a private company, it's quite difficult to acquire shares if you're an investor. You really need to approach company management directly if you want to acquire either a minority or a majority. There's not an open market venue where you can just acquire private company shares, where when a company's public, the exchange facilitates that for investors. It provides an open market venue, price transparency, and liquidity for buyers and sellers. Okay, so I'll just do a quick illustration here. I love my graphs and sketches and whatever, so let's just do one quick graph to show how a stock exchange works very simply. So you've got your exchange, you've got your buyers, so these are the buyers of the firm stock, they're providing demand, and you've got your sellers. So your sellers are providing liquidity. They're looking to offload their position in the stock. And what the stock exchange does, how the stock exchange adds value, is it connects buyers with sellers. So the stock exchange introduces the buyers to the sellers. It provides a venue that allows for transactions to take place. So that buy orders and sell orders can be made. Buyers who want to take ownership positions within the company are able to do so, and sellers who are looking to downsize or exit their positions in a company are able to do so. The stock exchange facilitates an active market, it facilitates liquidity, provides price and volume transparency, and yeah, it provides an open market venue which allows for public company shares to be easily transacted amongst different market participants. So yeah, that's everything I wanted to cover in the video. That's a stock exchange in a nutshell. Hopefully that was helpful. Any questions, feel free to fire them off in the comments, and I'll see you guys in the next video.